Hi there, ladies and gentlemen. It's James Marley here, co-founder of Livewire Markets, and welcome to this in-depth feature interview I'm conducting today with Brad Potter, who is Head of Equities at Tyndall Asset Management. The firm has been around for a really long time under different headings and headlines, but Brad has been one of the constants at the firm. He's been there for nearly 20 years. It'll be his 20-year anniversary coming up at the start of next year. He's a really experienced Australian equity manager with a strong focus on value. We're talking just after the Australian reporting season, but I think the bigger backdrop is also really interesting at the moment with the stimulus that's been in there and the talk of tapering. So we're going to pick Brad's experienced brain, get a bit of background on how he thinks about investing, and then we'll get into some topics that I think you'll all find really interesting. So Brad, great to catch up and welcome to the interview.
Thanks, James. Glad to be here.
Now, as I said, you've got a long history of investing. Early days, you worked on the sell side and particularly in the resources space. I was hoping you could share a particular event or an individual or an experience that's had a big influence on the way you invest and sort of how it's shaped the way you think about investing.
Yeah, thank you, James. Yeah, my early years, as you mentioned, was as a mining analyst, actually in WA, looking at the smaller end of the market, the explorers and small miners. And that really started my career in investing. And very early on, one of the key things that actually came to me during that period was listening to these investors, entrepreneurs, owners of these companies, and listening to what they had to say. It became quite clear that you had to be very careful on what they were telling you. And it led me to being very, I guess, cynical on what management told you. And so really that actually started and actually has really lived with me for all my career when listening to management and actually asking the question, really, what are they telling me? Are they actually telling me the truth? But more importantly, what are they not telling me? And I think that cynicism is very important when you're looking at companies and talking to management. And that stayed with me from that period, looking at those smaller miners.
Yeah, interesting. Did you tend to find? I mean, I'm interested to know management. Do they tend to be optimists, pessimists? Like, is there a particular trend that you pick up over time?
Yeah, look, I mean, particularly the smaller end, the entrepreneurs are very optimistic, and often won't tell you everything that's going on. But I think good management really will try to under-promise and over-deliver, and I think that's one of the keys for a good management team.
Yeah. As I mentioned in my intro, 20 years with Tyndall, that's exceptional longevity. But obviously you've traversed a number of market cycles and seen the whole, I guess, the structure of the investing landscape change. What are some of the big differences now to when you started investing, and what are some of the things that have absolutely stayed the same?
Yeah, interesting. Like I've lived through the 87 crash, the dot-com boom, the Asian crisis, long-term capital, the GFC, and obviously COVID. And so there's been a lot of volatility over those 20 odd plus years that I've been in the market. I think the biggest change for me has been really ESG. At Tyndall, we've always looked at ESG well before it actually had a acronym. And but the growth in ESG and what people are looking at, the fact of the decarbonisation, net zero, there's just so many investors. Lots of our clients are very interested in that and how you invest. And so that's probably been the biggest change by a long way over the sort of 20 to 30 years I've been in the market. What hasn't changed? I think value investing hasn't changed. You know, at the end of the day, value is all that matters. As Benjamin Graham said, the market in the short term is a voting machine, and in the long term, it's a weighing machine, which is a way to say that In the short term, the market volatility is there, but in the long term, all that matters is the underlying value of companies, and that really hasn't changed.
Well, value has a different meaning to different people. There are growth investors that say they can find value in high growing, high PE companies. And when we had a chat last week ahead of this interview, you said value is everything and you can't invest without value. Could you maybe give me a bit more detail on what it means to you and specifically with how you start to screen investments and implement your strategy?
Yeah, I mean, where I was going with that is that, a value investor ignoring growth is just as silly as a growth investor ignoring value. And so, if you don't know what the underlying value of a company is, then it's pretty hard to know when you should be buying or when you should be selling it. And one of the key determinants of alpha is really the price that you pay for a company. From Tyndall's perspective, our version of value is intrinsic value. We look at companies and value them on our long-term sustainable earnings, including cash flows, including dividends, franking credits, and then we generate an internal rate of return based on that valuation, and that gives us basically our signals for value for the companies. So to actually determine that intrinsic value actually requires a lot of work, requires a lot of meetings with companies, with their competitors, with their suppliers, and to determine what the underlying value of that company is. So that's the way we think of value.
We've just got reporting season. I know a number of people have called out the inflation pressures coming through from the companies as being a major theme. I'm just really keen to get your download on that from a value investing perspective, and just what are your views? Like, we've seen the 10-year bonds roll off, but these red flags or these signals of inflation coming through. What's been your take on it?
Yeah, I mean, I think the debate is out still on whether inflation is transitory or permanent, and certainly most of the central banks are certainly calling it transitory. I mean, I guess it's in their best interest to call it that at the moment. There's no question that we're seeing inflation everywhere in input prices. Oil price, for example, was at very low levels in 2020. In fact, was negative, at one stage in the US, believe it or not. But we're seeing that these inflationary pressures everywhere. Timber prices went crazy in the US. It's that they've actually fallen away a long way. Timber prices are very high here in Australia. Obviously, commodity prices were very strong, albeit iron ore has rolled off quite substantially from the sort of heady levels above $200. So there are inflationary pressures everywhere. The question is, are these permanent? And I think the debate is still out. I'm sitting on the fence on this at the moment. Certainly, the central banks want inflation at sustainable levels, as RBA came out the other day and continues to maintain that they want inflation within their band of 2 to 3% sustainably before they were looking at raising short-term rates. And their expectation is 2024 will be the first time that they will raise rates in current conditions. So I'm on the fence whether it's transitory, but there's no question we're seeing areas of inflation everywhere.
So if you're undecided, and I can understand why you take that view, how does that impact the way that you're putting your money to work and allocating within the portfolio, given that it has been a big swing factor? Maybe talk me through some of the implications of that.
Yeah, well, I mean, as you quite rightly pointed out, the long-term rates and low inflation has been a headwind for value investing for a long time. I mean, we're a bottom-up investor, and so we don't necessarily are looking for low PE or low price to book stocks. We're looking for stocks appropriately valued and look cheap based on our appropriately valued methodology. So that may be stocks that are leveraged to inflationary pressures, and also may have stocks that are not leveraged to those sort of inflationary pressures. As you said, that the increased bond yields did see the whole value sector, or the more likely the economically sensitive style stocks rally quite significantly, and that's rolled off a little bit. But I think that will return once the world starts opening up in a more sustainable way post this COVID-19 level.
I know a lot of Livewire readers are keen followers of the fully franked dividend trail. It's been in the banking sector. It's gone from drought to deluge with dividends. It's hard to believe that they were put on pause 18 months ago, and now dividends and specials and buybacks are hard to keep up with the pace they're coming out. Could you, I guess, give us a bit of a view on whether or not you think that the banks look attractive, and particularly with a focus on that income component, and what your outlook is from here, given that we've had that dynamic of no dividends, heaps of dividends? What's the sustainability like?
Yeah, I mean, the dividend yield of the bank sector is around 4.5% to 5% currently, fully franked, and that's definitely sustainable. Importantly, the banks all have excess capital, and we're starting to see that being returned to the market. So we've got three banks, three of the majors doing buybacks. NAB and ANZ are doing on market, and CBA has just done a very large, or is in the process of doing a very large off-market buyback. And our expectation is that Westpac at their results in October will also provide a very large off-market buyback as well, because they have excess franking credits like CBA and excess capital. And we think these buybacks will continue for a number of years, given the huge amount of capital that the banks have got. So those dividends and buybacks will continue. The banks as a whole, I mean, top line growth they're struggling with top line growth. Most of them have been selling off their non-core businesses, asset management, insurance, and so forth. And so top line growth's really struggled, because although mortgage growth is okay, net interest margin pressure is still there, and will continue to be there until we start seeing rates rise. However, EPS will be probably driven, and therefore dividend per share will probably be driven by those buybacks, and also by the write backs of those huge provisions that we saw them put in place during the middle of COVID. So EPS growth probably be okay, and DPS growth will be okay over the next few years, but it won't be driven by top line growth, more from write backs and those and the capital management. So
earnings growth and dividend growth in a low growth environment where cash rates are 0.1%, that sounds like a reasonable backdrop, albeit not being driven by that top line growth. What's your view from here? Are you overweight or underweight the sector? How are you positioning?
Yeah, the main fund, the wholesale fund, is modestly overweight the banks. From a value perspective, ANZ, Westpac, and NAB look attractive, and CBA looks very expensive to us. CBA is trading in excess of 2 standard deviations above their sort of normalized value that we would normally see. They're trading at sort of 4 to 5 price earnings points above the other three banks, and looks expensive, whereas the other three banks to us look attractive.
That premium that CBA commands over the others, you mentioned when we caught up that it's in a league of its own now. Does it have is it better place to grow top line? Like, why is it commanding such a dominant premium over the others?
Look, there's many reasons that people have come up with. I mean, it does produce a higher ROE than the other banks, and so it does deserve to trade at a premium. The question is, how much is that premium? We assume about a 15% premium to the other banks within our process, but it's actually trading in excess of 30% premium to the other banks, which we think is excess. We don't see top line growth being any better than the other banks. One of the questions is, who's the seller CBA at the moment, when you have a lot of the market underweight CBA, so they're not necessarily a seller. You've got retail investors making up a very large percentage of their book, and they're not a seller. And so, yeah, it's hard to find anyone wanting to sell the bank at the moment.
Yeah. Were there any other standout results before we move on from what we saw, throughout August? Was there anything else that caught your eye, or really stood out as a particularly high quality result, or something that caught your attention?
I mean, certainly M&A remains really a key thematic, and it has been for quite a while, and will remain a key thematic given these low interest rates that are expected to be there for the next 3 or 4 years. And in a lot of industries, top line growth is low, and so the way to grow the business is through M&A. We've seen some pretty big M&A being announced over the last month or so. We've got BHP vending in their oil business into Woodside, which will make them a very large oil business within Australia. We've got Santos and Oil Search looking to merge. Afterpay is going to be acquired by Square Inc. in the US, which is the largest M&A in Australian history. So there's a lot of M&A going on, and that's probably one of the key thematics that I saw, or I continue to see really in the market at the moment.
Often hear people talk about the surges in M&As and big acquisitions being peak cycles. Is there any hint of that, or is it just a function of cheap money?
I think it's at the moment there's a number of things going on. It's a function of cheap money, a lot of money on the sidelines. It's also a function within the oil and gas space. There's a lot of pressure on the decarbonisation. There's a lot of pressure on funding for new projects within oil and gas, and really you need to be arguably larger to be able to fund those sort of projects. And so that makes a lot of sense from an Oil Search Santos perspective. In the Woodside BHP, there's a lot of synergies between Woodside and BHP vending those businesses, and BHP obviously taking a view from a decarbonisation perspective and exiting the oil and gas business, which they've owned for decades and decades. Yeah.
Now, when I was doing some background reading ahead of our catch up, I came across a topic that's of interest to you, which is the human biases or investor psychology and how that plays out when we invest. And I think we all read the theory about it, and then we find ourselves committing the same mistakes over and over. I think it's one of the things that older investors do better than younger investors, well, talking from my own experience anyway.
Yeah.
I guess I was keen, just from your perspective, what are some of the ways that you see, biases and investor emotion playing out in the market, and if there are any examples that stand out at the moment?
Yeah, look, I mean, one of the classic ones is the old bandwagon bias, which is all about jumping on the latest bandwagon or so forth. And Warren Buffett used the phrase, be greedy when people are fearful and fearful when people are greedy, which is his way of trying to mitigate against the bandwagon aspect. And that makes just a lot of sense. You want to be buying stocks at the bottom and you want to be selling stocks at the top. That makes absolute logical sense. Unfortunately, people's brains aren't wired like that. They want to buy the latest thing. They want to buy things when they're going up, and when things are going down and at the bottom, they want to be exiting and selling when that's the opposite thing to do. And as a value investor, that's what we try to do. One of the aspects that's hard is, as a value, you can buy too early and sell too early. So you just got to try to manage that when you're looking at stocks. Across all the different sort of cognitive bias and emotional bias that there are out there, to actually try to mitigate against that, you need a really good process. And the Tyndall process, the peer review process that we have, which actually has robust discussions around stocks and value and the inputs, tries to mitigate against those bias, and actually having that logical, disciplined value approach. When stocks get cheap, you're at the bottom, and you're emotionally you're holding back from buying it. Your valuation process says you should be buying it, and so you step into the abyss and you buy it because that's what your valuation approach says. So you need that disciplined process, and obviously experience as well to try to mitigate those bias.
That's obviously in the context of a team there, Brad. What about yourself? Is there a common mistake that your team has to tap you on the shoulder and say, Brad, you're doing it again? Is this something you've identified yourself over the years within your own style?
I don't think the good thing about the process, the Tyndall process, we all have buy-in on the process, and it's actually hard to, and because of the peer review process, it sort of knocks out any of those that bias out of your any systemic sort of investing that you may have. I mean, certainly, we will make mistakes, like everyone will make a mistake investing, and we try to adjust when the new information occurs. We adjust whether we buy more or whether we exit or reduce our position. That's part of the process. I think one of the interesting areas, in the GFC, which was a really difficult time for investors. And in the middle of the GFC, value was being hurt really bad. Everyone was sort of gravitating towards defensive stocks, and the value stocks, the more economically sensitive stocks, including banks, looked extraordinarily cheap. But we were still in the middle of the GFC, and there was no knowledge, understanding when this would end. And the way to get around that was to gradually rotate the portfolio into those more attractive value, economically sensitive stocks. And it hurt performance because it was still, because the GFC was still impacting stock prices at that time. But it was the right thing to do, to just gradually move into those value stocks, because when the rotation occurs, it does occur pretty quick. And probably the one thing that I have some regret is that at that time, the banks looked extraordinarily cheap as well, and we probably didn't go as hard and as overweight as we probably should have in the banks. And the main reason holding us back was, the banks were at the center of the GFC, and we just didn't know what the final outcome was going to be. And as it turned out, the banks rallied extraordinarily out of the GFC as well, just like all the other economically sensitive stocks.
It's hard to know at the time, though. I mean, in retrospect, that these things become obvious. It's very hard at the time when there's all the noise, and as you say, it did feel like Armageddon. It was quite prolonged as well, the GFC, compared to the retrace we had last year.
Yeah, I mean, the COVID situation is just a very, very strange, because, I mean, it was basically a government mandated lockdown. So it's one of the quickest collapses we've seen, and also one of the quickest retracements. And from a bank perspective, it's just really strange, because the banks virtually have no bad debts. They have no impairments at the moment. Normally during a recession, you actually end up getting asset prices collapsing and so forth. But we've seen the opposite. We've seen house prices rise significantly. So the biggest assets in the banks are the mortgages, and so the actual issues around any sort of mortgage bad debts is completely disappeared, and they're not seeing, and stress is just nowhere to be seen within their book at the moment. So it's a very strange situation for the banks at the moment, coming out of the COVID recession.
Now we're going to finish on a quick one, a final question that everyone that comes on for a chat has to deal with. Could be a bit of a painful one, but hopefully a lesson in there too. Brad, what's been an investing mistake that's ultimately made you a better investor? What was the mistake? What went wrong? What's the lesson?
Well, I think I sort of said it earlier. I think the biggest one was really ignoring our process at the time in the GFC with the banks, when the banks were looking cheap like everything else, and they performed extraordinarily well post that. I mean, we always make the obligatory issues around getting inputs wrong into a stock, and therefore the value not actually being as good as what we're expecting. But that was probably the one that really stands out in my career, given it was sort of sitting there telling us to buy the banks, and we held off.
So the lesson was to stick to follow the process.
Correct.
And back the process rather than sort of tune into the noise around.
Yeah, correct.
Great. Well, Brad, I've really enjoyed catching up. It's actually been our first conversation, so hopefully it won't be our last. Congratulations on your upcoming 20-year anniversary with Tyndall, and I really appreciate you taking time to sit down and have a chat today.
Thank you, James. Appreciate it.